Hi, this is Sean Hyman from mywealth.com. I'd like to welcome you, and I want to talk about our blog of the day today, which is the Shanghai Composite Index. You can go to stockcharts.com, type in $SSEC, and that will bring up the chart that you see there on the blog. Recently, I've been noticing that index has broken a downtrend. It's in a sideways trend currently, but it's bumped up to 4-month highs. And I've also noticed that there's an ETF that has been perking up right along with it, the Morgan Stanley China A-Share Fund, ticker symbol CAF on that ETF, CAF. And you'll see that in the bottom part of the overall chart, which is the Morgan Stanley Fund below and the Shanghai chart above, contained within the same chart there on the blog. And let's take a look at the reasons, the fundamental forces that may be changing the direction of this chart. There's a big government spending program going on internally, domestically within China right now, which is a good thing because a lot of their former growth has been export driven, so forces coming from outside into China. And China's getting to a point where it needs to grow more domestically from within. So this is something that they're looking to spur some growth within. So they're taking these 4 trillion yuan, and they're going to spend it on things like technology, equipment manufacturers. They're going to support their exporters through extending more credit. They're helping their shipbuilders out as well. They're cutting taxes for the auto and steel industry. They're providing subsidies. They also have had 5 interest rate cuts just September alone. And it's also caused a tick up in the PMI numbers. PMI is Purchasing Managers Index. And so with tick ups in numbers like this and the prices of steel and different things like that, it shows that there's a shifting going on that looks like that's in demand for a lot of these goods as China really pours on the dollars to their domestic spending. Now, one nice thing to know is that China, of course, did slow down, but the nice part is that it is still growing. There are a lot of these countries that went to negative GDP or flat GDP growth, so their country literally stopped growing or retracted in this global slowdown. However, they're just averting a recession. And they have come out of this, you could say, the least banged up or beat up. So, being that they appear to be strengthening from internally as well, and their growth, while it did slow down, didn't dissipate as much as many other countries, they may recover and pull out of this thing quicker than many other countries as well. And so I think that's why you're starting to see that shifting on the chart. So again, this is not an outright recommendation or anything of that sort. It's just something to get you looking at. Do your own research and see what you think. If you believe in the future and the growth of China, you might want to take a look at that CAF ticker symbol on that ETF and see what you think. Also, I'd like to direct you to mywealth.com. Check out our blog by clicking on that tab. You can see all the latest blog posts from not only me, but also our other instructor, Bob. And you can also click on the Courses tab to see our courses on personal finance, on stock investing, on currency investing. Offer $25 online. You can access it 24 hours a day and get live instruction from instructors like myself and Bob O'Brien. Thanks so much. Bye-bye.